Many people think money disappears in a crisis, but it doesn't. It moves. As fear grows and confidence fades, money flows out of some markets and into others. And that shift is why some struggle while others grow. Gold and precious metals. When confidence in paper money, governments or economy policy start to fade, gold usually comes back into focus. People don't turn to gold for income, they turn to it because it tends to hold value when trust breaks down. Gold isn't tied to anyone's balance sheet, it can't be created at will, and it sits outside direct policy control. That is why it is often attracting capital during unstable times. The US dollar and reserve currencies. In global crises, the US dollar often strengthens even when problems begin inside the United States. This happens because a large share of global debt is denominated in dollars. Global trade relies on it, and when fear rises, markets look for immediate liquidity. This pattern reflects how deeply the dollar is embedded in the global financial system. Low-risk bond markets. As uncertainty increases, priorities change. Protecting capital becomes more important than chasing returns. Because of that, government bonds from credible issuers and other fixed income assets often see strong demand during crises, even when yields are low. In these moments, stability matters more than performance. Certain parts of the stock market. Not every stock performs poorly in a crisis. Companies that provide essential goods, generate steady cash flow, or are tied to everyday consumption often hold up better than others. During these periods, markets tend to rotate towards stability rather than rapid growth. Crypto. It depends on the crisis. Crypto doesn't behave the same way in every single crisis. When liquidity dries up, crypto assets usually come under pressure because they're seen as riskier. In situations driven by long-term distrust in the financial system, some cryptocurrencies can attract renewed interest. In fact, the underlying cause of the crisis shapes how crypto responds. Markets that feel pressure first. Markets that rely on cheap credit, fast growth, and strong optimism usually start feeling pressure early. When debt is high and liquidity is thin, even small changes in conditions can have a big impact, which is why these areas often come under pressure before the rest of the market does. In conclusion, during crises, markets that grow usually offer safety, deep liquidity, or independence from fragile confidence. The key question isn't where returns might be highest, but rather which assets are positioned to hold up the longest when conditions become difficult. Looking ahead to the next crisis, where do you think capital will flow most strongly? Do you feel it will be the gold, the US dollar, or fixed income markets?